Welcome to our informative series where we're going to continue sharing insights on mortgage secondary markets with the goal of boosting sales teams' understanding of this critical but often veiled component of their business. In this video, we're going to provide more details on mortgage-backed securities and to-be-announced contracts. We'll also talk briefly on how they relate to rate sheet pricing and the value of a locked pipeline. This will set us up to talk about how these important components of a mortgage lender's business are impacted by market conditions, which is the concept of interest rate risk. Mitigating interest rate risk and preserving margins are the two primary goals of a secondary department. So the information we're covering here will provide a critical foundation for future topics that are important to sales teams. This includes things like hedging lock pipeline, lock policies, rate sheet pricing, and more, all of which impact a lender's ability to offer competitive, consistent pricing to customers and the loan officer's ability to win deals. So let's dive into this important topic. Mortgage-backed securities are investments backed by mortgages that enable investors from around the world to own a stake in the U.S. housing market. MBS are considered fixed income securities because the underlying loans generate regular cash flows that are passed on to investors, providing investors with a consistent stream of income. In the U.S., most residential mortgages are pooled together and securitized rather than held as whole loans in the original lender's portfolio. These securitized pools of loans are actively traded in the bond market where they compete with other fixed income securities for investor interests. What makes them especially appealing to investors is that the fixed interest rates offered on MBS are typically higher than government bonds, and they usually have monthly payouts, providing investors with a regular return. MBS can be split into two major categories, agency and non-agency MBS. In our videos, we'll primarily be focusing on agency MBS since this is by far the largest market. Agency MBS are pools of securitized residential mortgages backed by Fannie, Freddie, or Ginnie. Non-agency MBS are often referred to as private label securities and are pools of non-conforming loans that are securitized by private financial institutions. Each agency MBS carries a guarantee from Fannie, Freddie, or Ginnie that investors will receive their monthly principal and interest payments even if underlying mortgages in the pool become delinquent. However, while the investors are guaranteed to receive timely monthly payments regardless of borrower delinquencies, they aren't shielded from prepayments. This includes borrowers prepaying their mortgages early or lenders buying delinquent loans from pools. This prepayment risk is a top consideration for investors when they're evaluating an MBS for purchase because it directly impacts their expected cash flows and return on investment. If loans prepay and leave the pools early, investors will no longer receive the payments on those loans, reducing their overall return. Unlike agency MBS, non-agency MBS doesn't come with any guarantees, so they're considered to be higher risk investments compared to agency MBS. Certificates for fixed-rate MBS are typically issued with coupon rates in 50 basis point increments, which represent the annual interest rate that the investors receive on the MBS. There's a liquid market for buying and selling mortgage-backed securities, so investors are able to purchase MBS ranging from newly issued to significantly seasoned based on their portfolio needs. Investors use sophisticated models to analyze and evaluate the anticipated cash flows of an MBS, which helps them establish the market prices they're willing to pay for an MBS and the calculated overall yield. Factors such as prevailing interest rates, overall market liquidity, economic sentiment, and key economic indicators like unemployment rates, inflation, and the condition of the housing market have a material impact on these calculations. When an investor wants to bid on a specific MBS, they'll also thoroughly evaluate the composition of its underlying loans and consider factors such as the weighted average interest rate of the loans, the weighted average maturity, and the prepayment and credit risk characteristics of the loans in the pools. What I really want to point out here is that since prevailing interest rates have a significant impact on the value investors give MBS, the prices of MBS are very sensitive to changes in market rates and any significant changes to economic sentiment. Futures for mortgage-backed securities are traded as to-be-announced contracts, or TBAs, which are primarily used for hedging mortgage pipelines. Since TBAs represent a futures market for MBS, the exact MBS and its underlying pooled loans to be delivered are not yet determined. Instead, in TBA trades, the specific securities and their loan level details are announced by the seller on the notification date, which is 48 hours before the trade settlement date. In a TBA trade, two parties agree on a price for a certain amount of MBS to be delivered at a future date. Because the pool hasn't been created yet and its details are unknown, TBAs are traded based on 6 agreed upon parameters: the guarantor, the maturity, the coupon, the price, the par amount, and a settlement date. TBAs for MBS issued by Fannie or Freddie will get a UMBS label, while TBAs for Ginnie Mae pools will carry a GN or G2 label. Like MBS, pricing for TBAs are also market-derived, with the prices for each available month and coupon being determined by market bids that reflect overall demand and investors' estimation of the value of MBS on the future delivery date. Investors bidding on TBAs consider the coupon and yield and many of the same economic factors as they do with MBS pricing. However, there won't be any analysis of loan level details since those are unknown in the case of a TBA. TBA trades generally involve the settlement period that falls within 3 months of the trade date, and the majority of trading activity takes place during the 2 months closest to the trade date. Remember this relatively narrow 90-day time frame for TBA trading because it's going to be important when we cover the risk associated with extended or long-term locks over 90 days in a future video. Another important point about this trading window for TBAs is that bid prices will deteriorate as the settlement period extends into later months. This is known as the drops in securities, and it reflects the price difference between settlement months. Additionally, investors become more cautious as the trades settle further into the future. For example, imagine a lender wants to sell 4.5 coupon UMBS 30. You may look at a screen and see bids for May are at 102.1, while bids for June are at 101.25, and July is showing 101.15. We'll be coming back to the drops in securities when we talk about locks and rate sheet pricing. TBAs can be bought, sold, or sold short for hedging purposes. While many secondary market participants can buy and sell TBAs, for the purpose of this video, we're mostly going to be considering buyers and sellers to be mortgage lenders and their broker-dealer counterparts. Selling short in relation to TBAs refers to a trading strategy where a lender sells TBAs they do not own, typically with the intention of buying them back at a later date. They take this short position either directly with the broker-dealer or indirectly with the broker-dealer's investors. When the lender buys back the TBAs, it's often referred to as covering their short or flattening their position. TBA prices are quoted in ticks, which refer to 1/32 of a percentage point. A plus refers to a half of a 32nd. For example, a UMBS 4 may be quoted at 103.13 plus. Simply divide the 13.5 by 32 to get the decimal. The difference in price between selling and buying a TBA is the bid-ask spread. As an example, if a lender took a short position at 103.13 plus and immediately decided to buy it back before the market moved, they could get quoted something like a 103.16. This 2.5 tick cost is the bid-ask spread and is part of the transaction costs associated with trading TBAs. As an example, on a $10 million trade, a 2 plus bid-ask spread would result in nearly an $8,000 transaction fee. This bid-ask spread is always present but can vary based on market conditions. In very volatile markets, or if investor demand and liquidity for MBS drops, the bid-ask spread will typically widen significantly. This bid-ask spread is important to note because hedgers of mortgage pipelines will be adjusting their positions daily, incurring the costs associated with the bid-ask spread. When we talk about the transaction fees and the cost of hedging as we get into lock policies and procedures, the bid-ask spread is one of the major contributors. Now that we've covered MBS and TBAs in a little more detail, let's do a refresher on mortgage locks and briefly discuss rate sheets before we tie everything together to introduce the concept of interest rate risk. Throughout the mortgage process, market interest rates are constantly in flux. To protect against the possibility that interest rates may go up between the time a borrower applies for a loan and when that loan closes, a borrower can lock in their interest rate. This rate lock guarantees the borrower a specific interest rate and terms for a mortgage loan and protects them from potential rate increases while their loan application is being processed. To provide borrowers with prices for rate locks, lenders provide originators with rate sheets that outline the available interest rates, points, fees, and terms for various mortgage loan programs. What's important to note here is that these rate sheets are derived from TBA prices. This means that TBA prices influence the pricing offered to borrowers, and if the TBA market shifts, a lender will update their rate sheet and prices to the borrowers accordingly. Therefore, like MBS and TBAs, lock pricing is sensitive to interest rate movement. For example, imagine I'm a loan officer and I offer a 4% rate to my customer at par. The customer wants to think about it for a few days, shop around a bit, and they choose not to lock at this time. 4 days later, the customer returns and they want to lock their loan. However, since the original quote, the market has sold off a point to price, and 4 3/8 is the new par rate. In this scenario, the customer would have to pay a 1% discount point if they want the original 4% rate, or they can choose the 4 3/8 rate for the same price as the original quote. Never a fun conversation for the loan officers. One last thing to mention on rate sheets is that since every loan in the lock pipeline is based off TBA pricing from the day of the lock, both the individual locks and the cumulative value of the lock pipeline are sensitive to changing prevailing interest rates. All right, we've been talking a lot about how MBS, TBAs, and the locked pipeline are all sensitive to market movement. This is the concept of interest rate risk, which is an extremely important topic. Interest rate risk refers to the potential impact that changes in prevailing interest rates will have on the value of financial assets or instruments. Mortgage-backed securities and their pricing are highly responsive to fluctuations in interest rates. When interest rates increase, MBS prices decrease, and vice versa. I want to pause here for a second because it's very common to hear about this inverse relationship between interest rates and MBS prices, but some people newer to the concept find it confusing without context. When we say MBS prices decrease when interest rates increase, let's use an example to illustrate how this works. Imagine there's an MBS available for sale with a 4% coupon rate. Initially, based on their analysis of the MBS, an investor considers bidding 103. However, interest rates begin to rise and the investor anticipates the availability of newly issued MBS with a higher coupon rate of 4.5% in the near future, which would offer a more attractive annual return. So, in light of the rising interest rate environment and changing market conditions, the investor revises their valuation of the MBS with a 4 coupon and is now only willing to bid 102 for it. The increase in prevailing interest rates has reduced the investor's bid, reflecting the inverse relationship between MBS prices and interest rate movements. Because TBAs represent a futures market for MBS, they're also highly sensitive to interest rate movements. Similar to MBS, when interest rates rise, the value of TBAs tend to decline as the future MBS they represent become less attractive to investors compared to other opportunities. However, this decrease in TBA prices can be favorable when buying TBAs that were sold short, as the TBA can be bought back at a lower price and result in a gain on the trade. Conversely, when interest rates fall, the value of TBAs increase due to the higher relative yield of the future fixed rate MBS. In this situation, if someone sold a TBA short, they will have to buy the TBA back at a higher price than where they sold, leading to a loss on the trade. Finally, let's look at the internally hedged locked pipeline. Because locked loan prices come from rate sheets derived from TBA prices, the locked pipeline is also exposed to interest rate risk. Similar to MBS and TBAs, as interest rates increase, the value of the locked pipeline decreases and vice versa. This is because loans in the locked pipeline that were locked at a lower rate compared to the prevailing interest rate environment will be less desirable to investors when the lender goes to sell. There's one extremely important point to make about the locked pipeline as it relates to interest rate risk. Locks that are still applications that have not yet closed are even more sensitive to interest rate move than TBAs, especially if rates are improving. This is because unlike closed loans and pools of closed loans, locked applications are still subject to borrower behavior. If rates improve, borrowers are more likely to leave for lower interest rates with a different lender or renegotiate those terms. This additional pressure in a lower interest rate environment means that TBAs and locked pipelines, while directionally similar, do not have a one-to-one relationship. Now that we've established the relationship between MBS, TBAs, and a lender's locked pipeline and how they all respond to changes in prevailing interest rates, we're ready to introduce the concept of hedging in the next video.